Today, I have the pleasure to talk to Athanasios Psarofagis, an ETF analyst from Bloomberg Intelligence. And prior to that, he held roles at Oppenheimer Funds, IndexIQ, and NASDAQ. And from my perspective, as I follow him on Twitter and elsewhere, he's the master of the ETF data, and he's producing charts and insights, answering every question I ever ask myself. So, Athanasios, I'm very excited to have you here. Welcome.
Yeah, thank you, George. I'm excited as well. I'm flattered that you asked me to be on.
Wonderful. Just to understand, can you tell us about your current role and also what led you to that role?
Sure. So I'm part of this team called Bloomberg Intelligence, and it's almost set up like a sell-side research firm. And we have a team that covers ETFs exclusively. We write research on not only products, but the ETF industry, all funds, really anything that's being touched by the ETF. I cover most of the US, but I've covered Europe as well. So I've looked at the universe globally, and I've been pretty lucky. I've always been in passive slash ETFs. I wish I could say I was smart enough to know back then that's where I was going, but I think I just got a little lucky. I was started at a firm that was using ETFs, then worked in the indexing world at NASDAQ, building indexes and doing research there. Then worked for an ETF provider, IndexIQ, launching products and positioning products. So I've really had exposure to all different sides of the business, and just got lucky that the industry is doing very well. It's one of probably the few growth areas in finance, and that eventually led me here. I've been at Bloomberg just over 4 years covering the industry. It's been great. I think I've gotten to see the industry from a lot of different perspectives.
It's funny that you say that because I had a similar experience. I was working in ETF for a while, but the first experience that I had with it was I was using it when I was at Deutsche Bank because it's something that people wanted to talk about, but I was trying to use ETF to sell other products, which I was more involved in. And I think only very late I realized how big it can be. And now it seems obvious to me that it should be a very important tool for all investors. And I'm sometimes surprised even that active management is still holding up so well. But can you tell us a little bit, for someone who are not necessarily in ETFs, how big is the industry and how has it evolved recently?
Yeah, for sure. So globally, we're at about 10 trillion, which it's obviously big, but if you look at all managed funds, I think they're about 60 trillion. I want to say globally. So ETFs are maybe 17% of the industry. Now, regionally, because you brought up a good point about what active is holding up better, and I think there's a lot of interesting regional differences. So ETF, the biggest market is in the US, and it sort of makes sense there. There's more cost obsession in the US. A lot of the advisory models are fee-based, meaning they're not getting paid a commission to sell a product. They're charging you a percentage of the assets. So the US is definitely, even though the US didn't invent the ETF, the Canadians seem to always get mad because it really started there, but the US really took advantage of that market and grew it so much larger. But you are seeing very good growth in Asia. And one of the things makes it such an advantage in the US is taxes, right? So we get it. ETFs are transparent. They trade on the exchanges. They can offer you exposure to a lot of different things. The US has this one loophole that they're more tax efficient than the mutual fund. You don't really have that in other regions. So it makes it a little bit harder for them to justify saying, oh yeah, buy the ETF over the mutual fund, because the tax efficiency angle is such a big advantage in the US. Granted, with the US being the biggest market, Europe had a record year last year in terms of flows. So you're seeing a lot of adoption of the product there. You're seeing new firms come in. And, now in the US, you see big announcements like Capital Group is entering ETFs. DFA is entering ETFs. These are behemoth asset managers that have been holding out. You still have quite a few holdouts in Europe. So it'd be interesting, like Schroders, Aberdeen, don't have an ETF business in the UK. I think eventually you might see them jump in as well. Then you have the Asia market, which is growing very quickly as well. So even though the US is the biggest, I think a lot of the growth is actually going to come outside of the US market. I think is just more regulation being passed. There's more focus on costs, on transparency. The ultimate just the ETF is a natural beneficiary of that. So I think as Europe starts to get a little bit stricter on that, and they're trying, right? They have MiFID too, and they're trying to focus more on cost. But I still think there's a lot of growth for some of the outside markets. US is still growing. I mean, US had a record year too, just when you thought the ETF market was plateauing. No, I think it surprised a lot of people that it's still growing very quickly. It's at 10 trillion, but I still think there's a lot of room to grow as well.
It grows as per the equities. Is the growth also coming from a switch from active to passive? Is that what drives the growth?
Yeah, so on a net basis, because I think that's a really good point. If you look at, and it really also depends on the asset class. So where it's a really tough spot to be as an active manager in the US is active equities. That's just been really hit hard. A lot of that is being lost to ETFs. And if you look at performance rates, and S&P does a report every 6 months called like their SPIVA report, which looks at active and passive performance rates. It's tough for active to beat out in equities. The performance rates are always really low. So if you're an active equity manager, you've been hurting for a while in terms of outflows, and all that's being absorbed by ETFs. Fixed income, they've been pretty safe, which just granted that's a different market. They don't, it's not as efficient. A lot of the bonds trade over the counter. Performance rates tend to be higher in fixed income. So fixed income but fixed income ETFs are growing quite a bit as well. So I think that's the next area that they're really starting to encroach on. But that active passive, naming convention is very interesting because a lot of the ETFs themselves, they're not just purely passive, right? It's not just owning all the stocks. There's, factor-based ETFs or thematic-based ETFs. A lot of the ETFs now are actively managed. So it's not even within ETFs, most of the launches are active now. That line is very cloudy. And, with these factor ETFs or thematics, they're really active in a way. Yeah, it's a rules-based. I know the rules, but there's very active inputs that go into it. How often do I rebalance? How many names do I pick? What names am I picking? Am I screening based on fundamentals? That's exactly what an active manager would do. They're just they're writing it down and they're automating it. So it's very cloudy, saying, yeah, they're going into ETFs, but they're not all just going into a Vanguard, purely passive product. They're going into all these other areas too, like ARK innovation ETFs, or all those are active, right? So it's just more of a wrapper switch. And I think people, especially in the US, have seen the advantage of the US, again, with the tax efficiency, the tradability. So it's just more of a wrapper change. And this is why a lot of the active managers now are having to launch ETF lineups. Either they're offering their active strategies or they're converting. That's another popular route to some managers are converting mutual funds straight into ETFs. So it's really a better wrapper. And I think more and more asset managers are finally seeing it. Some might be a little late, but they're seeing it. And so now that's why I think we had such a big ramp up even last year, that they're oh man, I need to get on top of this trend. And I think we'll see more and more of that in Europe. I think it's going to be a little bit slower than in the US, but I think that's going to be a trend. Maybe not conversions, but I think we're definitely going to see more and more active guys try to get into the ETF business.
Yeah, the name is actually quite interesting. We call it passive, but what you're explaining to us is that it's quite different. And ETFs are two things. They're wrapper. Historically, they were index strategies only, but you can also very actively trade index tracking ETFs. So do you think the name is a little bit misleading?
Yeah, no, I think that's a great question, because I don't want to get all, like philosophical, but what is passive, right? And even if you look at the S&P 500, which we consider the passive gauge, that's run by an index committee. They choose what names are in. So if you remember, there was the whole debacle of Tesla. Do they let Tesla in or not? Well, yeah, it met the criteria, but the committee had decided to let it in. There's nothing passive about that. There's a committee that decides what to get in. And now I'm going to get all nerdy on the index side, but even if you compare different index providers, MSCI versus FTSE versus S&P, you're going to have a different definition of what's a large cap stock. So even passive isn't really passive, right? There's very active inputs that go into it. How often they rebalance, when they rebalance. So really, you're right. Passive, what are you going to own? Unless you're just going to own everything. Maybe the closest thing to passive might be like a Vanguard total market ETF. That might be the closest we can maybe get to a purely passive, something passive. But really the trend, I think, is high cost to low cost. I think that's what it comes down to. And that's what the big, Vanguard is passive, but Vanguard is also very cheap. And cheap is one of the few things that works in the industry. It's one of the few guarantees that you might be able to raise some money. So it's really just a shift from high cost to low cost. And indexing is just conducive for low cost. ETFs are easier to run. They're less expensive to run. But for sure, I think the pendulum is starting to swing back because the strategies are getting more and more complex. So I've even looked at concentration within ETFs, meaning The ETFs that are launching now are more highly concentrated. There's less names. They're more high conviction. That's active. So it's almost like you're going into the wrapper, but it's coming back into the active, one of the active space. So it's a very, fast moving cycle. But I think it really just comes down to high cost to low cost. And as more and more like these barriers come down, that's really what the main trend is. Active passive, I think, is going to be completely blurred because, there's been a lot of regulation that passed in the US and something called the SEC rule, the ETF rule that helped make ETF launches very easy. Since that rule 2 years ago, there's actually been more active ETF launches than passive. Yeah, so you can't just assume now an ETF is passive, right? A lot of them are active. So for sure, I think we probably have to get away from saying active versus passive and more about high cost, low cost, or using things like active share or exposure differences. And I think, it doesn't sound as fun as saying active passive. That's just a lot more simpler, but I think that's just the reality.
Yeah, the low cost doesn't sound like fun, but it's fun when you consider the benefit to the investors. And I remember one piece from your colleague, Eric, which was about how much money was saved overall by Vanguard as they started this revolution and decreased the cost. And the calculation he made is that it's about 1 trillion in fees. And I think that's something really to ponder. That's a benefit for the investor.
No, for sure. I think as an investor, there's probably never honestly been a better time to be an investor. Um, you could build a global ETF portfolio, with some stocks, international bonds, commodities for like less than 3 basis points in the US. You could build one for 8 to 10 basis points in Europe. That's amazing. For 3 basis points, you can have a pretty diversified ETF portfolio. As an investor, there's never been a better time. And Vanguard for sure is a big driver of that. Not only did they bring their own fees down, but they forced everyone else to bring their fees down. So there's a secondary effect of them coming into markets and forcing people to bring their fees down. And Europe, in the US, I feel like they really own that market. And outside the US, they don't have as much name recognition, but they're definitely making a lot of waves. They're launching advisory businesses in Europe. They're bringing down their index, their ETF product fees. So there's forcing all the other issuers to bring down their fees too. There's a secondary, like I said, ripples of Vanguard coming into these different markets. But as an investor, there's probably honestly never been a better time to access the market for almost barely nothing. So yeah, it's been a great time to be an investor. Maybe not, I think the asset managers might not agree, in terms of their margins, how much money they're making, but for an investor, it's really the best time. Yeah, and that's actually really good too, because I had mentioned, yeah, it's never been a better time to be an investor. Yeah, you can buy a Vanguard fund, you can do all this. One thing I can never change or Vanguard can never change is your behavior, right? They can give you the funds, and if you just keep slowly allocating money into it, you'll be fine. But I can't stop you from when now what's happening with some of the Russia related news. I can't stop you from trading. So I think investor behavior is definitely the hard thing to overcome. And the thing is, let's say dollar cost averaging into a Vanguard ETF, it's boring and it's okay. I'm just going to keep doing it. Yeah, over the long term, it's probably the best solution, but it's really boring. And I feel like investors want to be occupied in the meantime. And this is why I think you have other things like thematics and ARK do really well. You can basically what we're seeing is essentially it's a barbell. You have one side is your really boring Vanguard cheap funds, and on the other side is your lean in, what you mentioned, the really high conviction, high turnover, very different stuff that I may be not getting in that Vanguard fund. So the Cathie Wood funds or clean energy or whatnot. So I think that's where we're going. The middle, I think, is going to be a tough spot. I think it's going to be either have to be really cheap, quote unquote, passive or as passive as you can get, or really, you can be more expensive on the other side, but more high conviction, very differentiated. And that's how we see the flows really splitting up. So you see Vanguard do really well, but then you see other stuff do really well too, crypto, thematics, factors. So I think that quote signify what we're seeing. I think the hardest part to overcome is behavior. That you can't change. It can give you all the tools. And you had mentioned about the trading, right? That yeah, ETFs are passive. But now, in January with some of the stuff happening with Russia, ETFs traded more than they ever did. So you can see the people are trading them, whether it's good or bad, we'll see. But for sure, they're just not people constantly allocating into these funds. They're being actively used. So they're either changing exposures or they're rotating in different factors or different countries. But yeah, I think behavior is the hardest thing for people to overcome. And, maybe about some apps and are coming out like robo advisors are trying to overcome that, just force people to invest slowly into a fund over time and let that compound. But for sure, I think that quote really nails what's actually really happening. Because at the end of the day, flows really tell the story, like where the money's actually going. There's stories and this and that and positioning, but really the flows are the end sign. And so that's how the flows are being going now. They're really just splitting on two different extremes. Yeah, it's hard. I had even written a research piece once, and there's never been a better time to jump in because of just all the flows, and that's where all the money's going. But there's probably never been a harder time to jump in because of all the competition. I mentioned there was a record amount of flows last year and record amount of trading. There was also a record amount of products that were launched, which means now we're almost at 3,000 ETFs just in the US. That's a lot of products to look through, whether for an analyst or for an investor. Vanguard has a huge advantage in that they're cheap. They're pretty much the cheapest in every category. And why it's so hard to compete with them? Because they're set up very different than most other firms in that they're mutually owned. And so for someone that doesn't know, what that means is the actual fund holders own the funds. It's not like a board of directors or a publicly traded company. So essentially, as the fund gets bigger and more money comes in, there's more scale, they keep cutting their fees, right? No one else is set up like this. So they have the advantage that actually the bigger they get, the cheaper they're getting versus other firms that are publicly traded or they have, boards of directors or shareholders to answer to. Granted, they have very similar lineups to Vanguard, but Vanguard really owns that core cheap space. And on the other way, the only way, if you want to jump in the pool with Vanguard, it's very competitive. Like, there's more money there, but it's very hard to compete with them. So what you're seeing is most of the new issuers that are coming out are not going where Vanguard is. They're going to go to the space where Vanguard's not competing. So something like ARK has done very well because it's also an area that Vanguard doesn't compete in. And most of the new issuers that are coming in are trying not to be purely passive, and they're trying to take advantage of that line you said, to lean in. They want to go very high active share, highly differentiated. It's never been a better time to be an investor, but for the industry, it's tough. As Vanguard gets bigger, as the industry gets bigger, margins for them come down. ETFs just have a much lower fee than active. It's the growing part of the business for these asset managers, but the margins aren't necessarily as good as some of the active businesses. And I think this is why they're all trying to do, span out into other things like direct indexing or high concentrated active ETFs, because it's just tough. Where Vanguard is, it's tough. They really have set the floor for cost there.
So we've spoken about the Vanguard model and how successful it is. I'm curious about why then has no one tried to copy?
I think it really comes down to a profit motive. And it's not in our intuition when we're starting a business to say, well, all the money, all the profits I'm going to make, I'm going to give it back to my customers. It's just not the way I think normal people think. So you have to really admire what Bogle did when he started Vanguard. And this was even from the beginning. It wasn't that he started it and then changed. From when he established it, when he left his old firm, he says, I'm going to start a business that's mutually owned from the beginning. And it slowly kept expanding. So I think that's why people haven't copied it. They've tried to copy it. There's been a few opportunities for like other asset managers to be mutually owned, but no one's done it. And in Bogle's book, he actually brings up what he thinks the future is going to look like. And he thinks that most firms, in order to stay competitive, are going to have to eventually mutualize and copy the Vanguard structure. But like I said, we haven't really seen any in the asset management space, anyone else do this. So I think that's why you haven't seen anyone really copy it, because there's the profit motive goes away. And so really, how can you have a lot of these public companies, a lot of these asset managers are public. So how can you also have shareholders and fund holders? You can't answer to both. And that was Bogle's really his big gripe was like, you can't have shareholders who have profit seeking and fund holders who care about costs. So he was only focusing more on the fund holders. And I think that's why it's been so hard for anyone else to copy.
Yeah, we're going to go to crypto at the end, but I think it's something that perhaps only I could see a little bit of that in the ownership model of crypto, where they're trying to get people to be involved as customers and owners of the token. So maybe the Vanguard model could somehow, if it hasn't been picked up in the asset management industry or anywhere else so far. Maybe somewhere there, but
Yeah, that's a good point. I guess if you sort of think about it, the original DeFi is Vanguard in a way. They were like the original people to do this. So there's definitely a lot of parallels. Yeah, that's a good example with what's happening with crypto now.
Yeah, I feel like they're not referencing, there's so much talk about ownership economy, but not enough referencing of Vanguard, perhaps because it's 50 years old. So it's gone to the investment archives. But there we go. We've revived it, at least for a little bit. And to move on, I want to ask, so you mentioned there's never been a better time to be an investor. It's easier, cheaper. There are more ways to get involved. You can trade super actively with something like Robinhood, or there's also apps like my previous guest, Wealthyhood, which allows to invest automatically for the long term in a very seamless way. What do you see in your data through the trends in the evolution of investors' behavior? And I guess it might be very different in 2021, where it was going up all the time, and 2022, where we have a very different market pattern. But is there any insights that you can share with us?
What I thought was really interesting, especially for last year, which was a record in ETF flows. Vanguard had its best year ever, and then the rest of the industry had its best year ever. So what I mean is there was this complete splitting. So Vanguard was taking in a lot of money. So that tells me that people are still low cost allocating, slowly putting money to work in these really cheap Vanguard funds. But other things like crypto, thematics, ARK, all that had taken in a lot of money. So what happens, I think, with behavior is, yeah, and Bogle has said this too. He said investing should be really boring. It shouldn't be exciting. Just put dollar cost average into a passive index fund. But I think behavioral wise, a lot of people don't want to just sit there and just watch slowly the money grow. So they have to be distracted, which things like crypto, thematics, all these other different like non-core Vanguard funds have done really well too. So that could be good and bad, because I think with some of these other thematic ones, you get a lot of performance chasing. So you've seen that with the ARK funds, the performance has been really good the last couple of years for them. A lot of the flows came in after the fact. There's a lot of people now underwater on that ARK fund. But I think what we're seeing with the issuers, I think issuers that don't necessarily want to go into the Vanguard pool could potentially do well, because they're not competing with that core allocation of the fund. And it's something very different. They're offering something very unique. And the flows, and I think I'd mentioned it before, that to me, that's the end all sign. Flows just tell you what's actually really happening. You can launch products, you can have ideas, but if people aren't allocating to it, it means they don't want it. So I think the market is pretty efficient in that they will allocate the products that they want. So that's why I thought 2021 was such an interesting year, because you had the barbell split even further than it has before. The middle ground, I think, is going to be a little bit tough. Like, you have to be very different or very boring. I think just trying to be a little bit different, I just don't think it's going to be enough to get people's attention. So that's definitely how we've been seeing the flow split up.
What about the differentiation between wrapper and indexing? So ETFs used to be index strategies, and now we see ETF as a wrapper, but potentially being used for other things. Okay. And active strategies.
Yeah, that's a really good point. And I think the other thing where this sort of is very different is regionally. So we tend to have a very US focus just because it's such a bigger market. But if you look at somewhere like Europe, the ETF has done well, but people there tend to prefer the index fund. It's fine. So it's very easy to relate ETFs to just pure indexing. But actually, it's going to get very fuzzy, because if we look at over the last 2 years, most of the ETF launches have been either active or active. And what I mean by active, it might be an index, but it's a factor index, it's ESG, it's thematic. That's not necessarily pure passive. So I think we have to get away from just assuming that the ETF is purely just a passive product. But with people wanting to just go indexing or want to buy a cheap ETF, if you look at other regions, the mutual fund is okay too. It does the same thing. And actually, Vanguard mutual funds do well in the US as well too, especially in areas where the ETF can't get into. So for example, 401k and retirement plans here, like corporate sponsor plans, the ETF can't penetrate that market, so people buy index funds. So I think it's important for people to also understand that not every ETF is just a passive market cap weighted index. The innovation, issuers are going to keep constantly pushing the envelope, and they're going to have to move away from just trying. If anyone can now launch another S&P 500 ETF, I don't think it's going to do well. That's a very crowded space. It's already been taken over by Vanguard and iShares. So they have to move away from that. And so a lot of the product innovation that we're seeing is very active, like they're using derivatives. So that's why I think people have to really understand that it's not, well, see clearly the ETF wrapper is more efficient. That's why you see asset managers moving in, they're converting to ETFs. But I think it's very important, to your point, to not necessarily just assume that every ETF is like purely like dumb passive, and it's just because they're very active now in their product development. So it feels like we're coming full swing a little bit. Like they've disrupted active, they've gone passive. Now the ETFs are starting to get more active again. So it's very interesting to see how this is all.
And what's interesting as well is there's basically two brands that we mentioned here, and perhaps it's a coincidence. There's ARK and Vanguard, and there seem to be as well two companies that have strong brands, whereas the rest is a lot more muddled. What are some strategies that people try to stand out and perhaps make more noise? And one thing that I've observed, and I don't know if it's a trend, it's the creator-led ETF, such as the Matthew Ball Metaverse Index and ETFs that goes with it. What do you think on that?
Sure. So product development and like working behind the scenes, that's just one part of launching an ETF. And there's a lot of work. But actually, a lot of the work starts after it's been launched in marketing, distributing it, raising assets in the fund. So what we've seen now is a lot of ETF issuers partnering with big name, either social media influencers or advisors, or we saw David Portnoy, Barstool, like partner up with an ETF that raised a lot of money. So I like that idea, especially with something like the Metaverse ETF. They found a specialist. As well as a specialist in the Metaverse, they partnered with him. You even see advisors now, they are taking their strategies or money that they're running, convert it into the ETF. So I think we'll definitely see more and more of this marketing partnerships with ETFs to try to raise money. Because there's a lot of very interesting products that get launched and they just sit there with no assets, or they don't get a lot of awareness. A lot of people, distribution sometimes is very hard to quantify, right? Because it's very easy to launch a product, but sometimes you can have a very good product that doesn't get distributed well, and you can have a subpar product that has great distribution, great marketing, and can raise a lot of money. So that's a very important factor in ETFs as well that I think goes underappreciated, the sales and the distribution efforts after it's actually launched. But I think for sure we're going to see more and more advisors, partnerships, especially with any type of like social media influencer that has a very dedicated following. We can see more and more partnerships with ETF brands. You had mentioned Ritholtz too. They have a very strong social media presence and an advisory business. They partnered with WisdomTree to launch a crypto indexing service. So for sure, I think this is going to be one avenue that's definitely going to continue to be really for providers.
So there's the innovation and changes in the manufacturing, but also in the distribution. And I think maybe it's about time that the ETF industry comes to speed with the rest of the market.
On that distribution front, when people always ask, well, why is passive adoption lower in Europe, right, or in Asia? So let's say passive ownership is about 40% here. Like passive, it's only about 20% in Europe, about 25% in Asia. And it really comes down to distribution. So if we mentioned that S&P SPIVA report that looks at performance. Active performance has been bad across the globe on all different time frames in Europe and Asia. But Europe has a very different distribution model, right? They still are incentivized to sell active strategies. They don't get paid on ETFs. So I think once those barriers come down, it could be a good tailwind for the ETF. But this is why distribution plays a huge role into the adoption of these products. And the US models, those have been completely broken down. It's more fee-based. Europe still has a lot of kickback models, retrocession fees. So you have to sell active, and the banks sell their own funds. They don't really need to sell you the ETF. So I think as there's more pressure on that, that's really going to be a huge advantage for the ETF or just even indexing in general. But until those distribution models are brought down in Europe, or at least, made more efficient, it's going to be, I'm very surprised given all this, how ETFs, how well they have done in Europe. But I think once that comes down, the growth is going to accelerate even more.
Yeah, this alignment of incentive has been a story for so long that, I used to work in the industry over 10 years ago. We're starting to talk about it, and it's still not completely done. So maybe it's going to take a longer than we expect. Another trend, which I think is really interesting, is custom indexing. So it's perhaps not so much the ETF space, but it's adjacent. And do you see that as something that is really meaningfully taking off and potentially taking a large chunk of assets?
Yeah, custom indexing, some call it direct indexing. So really what that wants to do is eliminate the ETF in a way and just own direct. So to be fair, institutions have been doing this for a long time. So even if you look at someone like BlackRock's assets, yeah, they have commingled funds, but they do a lot of indexing outside the ETF or the fund wrapper. And a lot of the banks in Europe do the same thing. UBS, DWS, they all do this already. I think custom indexing / direct indexing is really trying to democratize that and offer it to really everyone else. A lot of people have said this is like an ETF disruptor. I don't really see that. It's really tough to disrupt a 2 or 3 basis point product that trades efficiently, that's tax efficient. I don't care how tax efficient you claim that direct indexing could be. That's very hard to disrupt. I think there are a few pockets that it could do well, probably one being ESG. What I mean by that is everyone has a different definition of what ESG means to them. Some are okay with these companies, some are okay with that. When you buy an ETF, that product is off the shelf. So it not necessarily might not meet exactly what you want. So I think customizing there could be very interesting. I don't like this index. I don't like this ETF, the way they run their ESG process. I want to run my own. Or if you have a very special situation, I work at a company, like a big company, I have a lot of stock options at that company. I don't want to own that company in SPY. So I think there's a couple very interesting use cases for direct indexing, but I don't see it as appealing to the masses. I think there's a very special case that people can want to use it. If you just want to replicate the S&P 500 in direct indexing, I don't think that really makes a lot of sense. Probably be more expensive, less tax efficient. But one thing that is really interesting is the technology is so much better now with direct indexing. And so you could easily go online, click whatever stocks you want, hit trade, and it'll trade it for you, rebalance it for you. I feel like we never really had that sort of technology before. I think that could be really appealing, especially, we've seen with some of the retail investors over the last year or so after COVID, and they got really involved in the market. People still like picking stocks. So what if you're like, well, I want to build, it's almost in a way like building your own ETF. I want to pick these stocks, put it in this portfolio. Yeah, I want to stay within 5% of the S&P 500. So there's a lot of really cool platforms that allow this. So it might do better than I think people expect, but I don't see it as this massive disruptor. And I had mentioned ESG and sort of special cases. And I think crypto is one other area that it could potentially do well because there's not an ETF there. And what we found is areas where there's an ETF, it's very hard to disrupt. Now, Europe is ahead of the curve on here. They have physical crypto ETFs. The US doesn't. They're petitioning very hard with the SEC to try to get those approved. But I think if direct indexing can get to the investor first before the ETF, I think it might have a better chance in that space as well. Because especially with crypto, I think people want to own the underlying, right? Versus with stocks, I don't think if that's as much as an issue with people. Like, hey, do you care if you actually own the stock? Unless you really care about voting rights and things like that. I think it's probably a bigger concern in crypto. So I think that's one area too where I think custom indexing could do very.
That's really interesting. It's actually a perfect segue for my next question because I was going to explore the cryptocurrency ETFs or ETP market. And there is one ETF, right? That's indexed on crypto, but on its futures.
Correct. So that's all the SEC allowed in the US was futures-based crypto ETFs, which have their own problems with roll costs and trying to track. And in Europe, there's been crypto ETFs, ETPs since 2015, and they're physically backed ones. So clearly the wrapper works. And I think issuers have figured out issues, how to custody, how to trade them, how to create units and whatnot. So it doesn't seem like it's really an issue, the wrapper itself and being able to manage it. So right now it's just a futures ETF in the US. It's done well. It's raised a decent amount of assets, but there's about.
I thought it had done more than one. I thought it was one of the most successful launches ever. There were headlines about $1 billion raised in days.
I think you're right. I think it was, in terms of an asset raise, the most successful asset raise in a single day in day one. So can you just imagine what a spot ETF is going to do on its first day? It'll probably shatter every single record there's about 14 or so different issuers in the US that have filed for a physical ETF. Most of them have been rejected. The SEC is just going down the line and rejecting everyone. So that's going to be, and there's some other products. There's a trust by Grayscale that has its own problems as well. It trades at pretty significant premiums and discounts. So there's no, really perfect product in the US, at least in the ETF or commingled fund form, which is why I think that question you had about direct indexing is really interesting, because I think this is one space that it could do well just because of the issues and the hurdles they're having to face with getting an ETF launched.
So if we go back, so there's different aspects to this, bridging the ETF or ETP word and the crypto word. So one we mentioned, there's an ETF, but it's structurally underperforming because of the role of the future, and seems like a fairly inefficient way of doing it, if you ask me. Then there's ETPs, which are probably more true to the nature of the asset and they own physically, but they're called ETPs and therefore probably limiting the access to some participants. And therefore that's trying to bring the crypto word to the, let's call it centralized finance, traditional finance. There's something that's emerging, and it's something that I'm quite curious about, is the indexing and asset management on the blockchain. And it's at very early stages, but we could imagine that this develops as well. And there's more indexing, let's just say, first of the crypto asset.
Yeah, I agree. And you've seen a lot of the index providers start to do a lot of work here. S&P, some of the small ones. The S&P is just a big brand name. They seem to have been one of the first ones to really start to look more into this space. But then if you look at, that's such a good point about the actual just usage of the product in asset management. And I think it was Fidelity first, and they're doing a lot of work here too. I think they were doing a money market run on the blockchain. So actually like implementing a fund using this, not exposure to these companies, but actually running the fund like that. So where I think this could really be a big disruptor is in areas like that, or even on, how settlements work with, my brain just always constantly goes to ETFs, but on the settlement aspect of it, can they maybe settle faster, more efficiently on the blockchain versus how it's set up now? So there's definitely seems to be some use cases for this impacting the operations of the ETF more efficiently, as opposed to just an ETF giving you exposure to these companies. And that actually probably might even be a more impactful usage to the, for asset managers, as opposed to just offering a product with exposure, but actually using that technology to better run funds. And Fidelity, I'd keep an eye on them because they seem to be jumping in pretty heavily into this. Even Vanguard has mentioned it. So you're saying even if they're like looking at it, that says a lot, right? Because they're pretty boring. They're pretty plain vanilla. But if they're starting to look at it as well, I think that holds well.
Yeah, I could see it. We're speculating here, but I could see multiple steps in this evolution. The first one is trying to bring crypto to the ETF world. The second could be potentially doing indexing or creating indices on the blockchain. And I'm not so much aware of it, but indeed, I had a guest from Fidelity earlier. He mentioned the works of Fidelity Digital Assets, which are probably a leader in that space. So I guess, if I wasn't aware of the work of S&P and others, but that's something really interesting to watch. But then there's probably a third step, which is using the blockchain as infrastructure to create the indices and settlement, etc., of all kind of assets, including physical assets, but it might come quick.
Yeah, it might come here faster than we think. And yeah, I think anything that they can do to want to operate ETFs or any settlement funds efficiently, even if you look at, let's take the current situation with what's happening in Russia and having access to securities, and there's huge settlement issues and whatnot. I'm not a crypto guy. I don't know like the whole intricacies of it, but this could have been maybe a use case where it maybe come in handy, right? With funds that can't access the market or whatnot, or trying to settle it off a centralized exchange. So I think there could be in the future definitely use cases for it.
Yeah, it's an interesting space, and it's pure speculation because from what I've seen, the attempts that even a big player like Coinbase has done has been fairly unsuccessful. I think they tried a couple of times to do indices or, some kind of basket of crypto, and they dropped it. So obviously there seems to be appetite for ETFs, appetite for crypto, but putting the two together is difficult. So I think that as we come to the conclusion, is there any other area of investing that you think is particularly exciting?
Yeah, I tend to be a little bit more boring, but I think there's a lot that could be done on the bond side and fixed income. Everything tends to be very equity focused, but I think there's a lot of work happening in fixed income. And I think sometimes that gets underappreciated. And I know it's probably not the most exciting, it's for different investor bases. But that's definitely one area that I keep watching very closely. I think, it's really dominated by BlackRock right now, but I think there's other issuers trying to jump in. A couple SEC rules last year made it a lot easier for other providers to jump into fixed income. So I think that's definitely one area that is going to be one to watch. And thematics too. I think it's really exciting. And I think people sometimes quickly dismiss thematics as, they're gimmicky, which some could be. I want to say that there's some products you look at them like, well, I don't get this. But I think the thematics are very interesting looks into the future. And what I mean is we're all, S&P and MSCI are changing the way they're looking at industries, right? They're making some big changes next year. And thematics are way ahead of that. So almost thematics, to me, provides a look into how maybe industries and companies could look like in the future. So I think sometimes people want to dismiss it very quickly. And I've done this too. But then when you see when stuff gets adopted more broadly, you're like, well, thematics were way ahead of this years ago. It's better to keep more of an open mind. But I think thematics is definitely going to be one of the other interesting areas, only because as Vanguard grows, people have to look for more stuff outside of the Vanguard pie, and Vanguard keeps growing. They're like not stopping. That's another area that I'll definitely be keeping an eye.
I'm trying to jump to crypto, which is further ahead. You realize how much work there is to be done in terms of ETFs in the fixed income space, which is a bigger asset class than equity. And I guess things need to be reinvented there, right? Because one of the conversations I had was with a fixed income ETF provider called Tabula. And one simple thing is that if you do the classical capitalization weighted strategy, you put more debt into the biggest issuers of debts, the most indebted company. It's not what you wish to do. So there's a whole universe, not just of products, but rules, classification, etc., that can expand.
Yeah, it seems backwards, doesn't it, right? When you're like giving more weight to the more indebted names. And you had mentioned the universe is so much bigger, and a lot of that universe is probably unindexable, or they're not being included in indexes. And this is probably one of the areas that we're active has been pretty isolated from the growth of ETFs because it's much more of a fragmented market on the trading side. But clearly fixed income ETFs trade a lot. They're one of the most heavily traded products on the exchange. So there is this thirst for wanting to sort of exchangize these products, exposure to fixed income. You see it in what happened in March of 2020, when the credit markets froze up, the ETFs, that's where everyone went for liquidity. So I think as more and more innovation comes in, not just from ETFs, but I think any type of like market structure innovation is going to be a big benefit for the ETFs. But it's definitely a space that I think there's still a lot of room for development, even though they've been around for a long time. They're very concentrated in just a few products. And you mentioned Tabula, they're a really great firm. I like some of the stuff they're doing. They try to do, offer like CDS exposure and some Euro credits and so inflation plays. So I really like some of the innovation that they've been doing.
Wow, yeah, we've covered a lot, but it seems like, we'll have plenty of to talk about again in the future with what's expanding in the ETF and indexing universe. Before wrapping up, I just want to ask a few personal questions, if you don't mind. And the first one would be, what would you do if you were to choose a different career path?
Yeah, that's a good question. I definitely would be an airline pilot. I always, from a young age, had an obsession with planes. I actually have a pilot license as well from a young age. Definitely what I wanted to do when I was younger. And then, as with life, some things change. You change interests, and didn't end up doing it professionally, but probably would definitely be an airline pilot if I could go back in time.
Wonderful. I wanted to be a captain. I still want to be a captain, but it seems a bit hard.
Like a ship?
A ship captain. I've never said that before, but since you mentioned pilot.
Well, now we got the air and sea covered.
And as the last question that I always ask my guests, how do you invest personally?
Sure, it's just because of my role, I can't say too much, but me as an investor, I'm pretty tend to allocate to just pretty boring index funds, just because of the nature of my job. I'm very in deep in some of these ETFs. So I do have some pretty interesting picks out there that I will say they're not necessarily the biggest products. So it's very easy to gravitate towards the big ones. But for anyone who's like looking to invest, don't just purely screen on assets or fees. There are some very interesting, innovative products as you go further down the spectrum. And so I have some of those as well that I think are really innovative in their own respective asset classes. But for the most part, I'm a pretty boring, just consistent allocator to index funds.
I would have been very surprised if you said you're a stock picker, but there you go. That's a different approach. Connoisseur's approach to ETF. And thank you so much for sharing all this with us. It's been a very interesting journey into the world of ETF, and it seems like something that there's going to be so much more to discuss in the future. But in the meantime, we'll keep reading you. And can you tell us just a bit about where people can find you and find information about ETFs?
Yeah, for sure. So we're on the Bloomberg Terminal. If anyone has it, it's BIETF is the function. But we're also very active on social media. I have a very unique name. There's no one else with this name. So anyone that can search my name, I'll come up. I'm on LinkedIn as well. We try to publish our research. And I have a bunch of colleagues too, Eric Belchunas, James Safer. Any one of those names were a very good, strong team. So a lot of our insights, we're constantly putting our own our insights out there. Look at any of those names, so you'll be able to track some of our research.
Yeah, that's definitely my resource for figuring out what's happening in the ETF market. And we'll put all the links in the description below. Thank you so much, Athanasios, and wish you all the best to you and the team.
Yeah, thank you, George. This was great.